Imagine holding the winning lottery ticket to the greatest technological gold rush in human history. But every time you try to cash it in, a lawyer taps you on the shoulder and says, not so fast.
Yeah, that is a frustrating position to be in.
It really is. Today, we're looking at Supermicro Computer Inc., or, SMCI, as you probably know it. I mean, this is a company bringing in over $20 billion, literally building the physical backbone of the AI revolution. And yet Wall Street is treating it like it's completely radioactive right now.
Oh, absolutely radioactive. It's fascinating.
Right. So I have to ask you, the listener, as you look at your own portfolio, is this tech giant an incredibly undervalued strong buy right now? Or is it a dangerous value trap, with flashing sell signals just waiting to crush retail traders who think they're getting a bargain?
It is the absolute definition of a battleground stock today. I
Yeah.
mean, the tug of war between the bulls and the bears on this one, it isn't just a disagreement on valuation. It's a fundamental disagreement on reality itself.
Yeah, and that is exactly what we're going to tear into. Today is April 20, 2026, and our target for this deep dive is SMCI. Our mission here is to look at the latest news, the extreme price trends, the massive financial statements, the technical analysis, and really pull apart this whole raging bull versus bear debate.
There is definitely a lot to pull apart.
For sure. Now, before we jump into the actual numbers, a quick piece of housekeeping. Please remember that this deep dive is strictly for educational purposes.
Right. No financial advice here.
Exactly.
Yeah.
Absolutely not financial advice. We are just analyzing the data and the mechanics behind it. Also, if you're finding value in this, please make sure to subscribe to the audio feed in whatever podcast app you're using. And leave a comment or review with your own feedback on this stock, because we really want to know where you stand on the SMCI debate.
I'm really curious to hear what people think about this one.
Same. So, okay, let's unpack this. We have a lot of competing narratives floating around, but I want to start with the objective reality of the market. What exactly is SMCI's price action telling us today?
Well, to understand the corporate drama, we really first need to look at the actual footprint the stock is leaving on the charts. So right now, SMCI is hovering around a market cap of roughly $17.3 billion.
Okay.
And they closed today at $28.81, which is up slightly. They gained about 0.88% in the last session. But honestly, that daily blip is completely irrelevant noise when you zoom out.
Right, because the broader picture is just wild, like completely wild.
Exactly. The 52-week range is staggering. We are looking at a low of $19.48 all the way up to a high of $62.36.
Wow.
Yeah, that is a massive spectrum of volatility for a company of this size. But here's the critical data point for right now. The stock recently executed a massive 47.9% bounce directly off that $19.48.
Almost 48%. That's huge.
It is. When we analyze the order flow at that level, we saw a massive injection of institutional liquidity. Active buying interest created what we call a hard technical floor right between $20 and $22.
A hard technical floor. So meaning there were just so many limit orders stacked up by the big buyers at $20 that the selling pressure literally couldn't chew through it, right? Like the buyers just absorbed every single share being dumped.
Precisely. They basically refused to let it drop below that zone. So the price slingshots back up. But we have to look at where it is now relative to its historical averages.
Right.
SMCI is currently trading at $28.81. That puts it just above its 50-day moving average, which is sitting at $28.48.
Okay, slightly above the 50-day.
Yeah, but it is still miles below its 200-day moving average, which is way up at $38.77.
Let's visualize that for a second. Think of the 200-day moving average like the gravitational pull of a massive planet. When a stock plummets that far below its long-term average, escaping that gravity requires an immense amount of fundamental rocket fuel.
I love that analogy.
Thanks.
Yeah.
Bouncing above the 50-day average is like, I don't know, achieving low orbit. Sure, you stopped crashing into the ground, but you are still heavily weighed down by the long-term downward trend. I mean, it's going to take a lot of energy to get back to that $38 level.
It really is. And that energy or, momentum is sending really mixed signals right now. What's fascinating here is the conflict between two major technical indicators.
Okay, lay 'em on me.
First, we have the MACD, the moving average convergence divergence. Right now, it is flashing a textbook bullish divergence.
Okay, let's break that down for someone who maybe doesn't stare at charts all day. A bullish divergence is when the actual price of the stock makes a lower low, but the momentum indicator makes a higher low.
Yes, exactly. Think of it like a car rolling down a steep hill. The car is still moving downward. That's the price hitting that $19.48 low. But the driver has started stepping on the brakes. So the downward force, the momentum, is getting weaker even though the car is still technically lower on the hill. It tells us the selling pressure was exhausting itself, which is exactly why we got that massive 48% bounce.
So the underlying engine is revving up, trying to reverse direction. That sounds incredibly positive for the bulls.
It does sound great, but then we have to look at the RSI, the Relative Strength Index.
Right, the RSI.
Yeah, which measures the speed and change of price movements on a scale of 0 to 100. Right now, SMCI's short-term RSI is sitting at 77.51. And in technical analysis, anything over 70 is considered mathematically overbought.
So if the MAN-CD is the engine revving up, the RSI over 70 means the engine is currently overheating.
That's a perfect way to put it.
It sprinted too fast from 19 to 28 bucks, and now it's just completely out of breath.
Exactly. It moved way too fast, way too soon following that bounce. Because the buyers are exhausted in the short term, the immediate resistance level we are watching is sitting right above the current price, right between $31 and $33. It is really going to struggle to break through that ceiling without a period of cooling off first.
So the technicals show a stock that is fighting gravity. I mean, it's survived a crash, but it's exhausted. But charts are really just a visual representation of human psychology and, order flow. If we want to know why buyers might be exhausted at $31, we have to look at the actual cash engine of this company.
Absolutely, the fundamentals.
Right. Are they actually making money? Because I am looking at the financials here, and the top-line revenue numbers are absolutely heavyweight.
They are on an entirely different scale compared to even like 3 years ago. I mean, annual revenue is sitting around $21.97 billion.
Incredible.
And their outlook for Q3 of 2026 alone is expecting over $12.3 billion in a single quarter.
Let that sink in for a second. $12 billion in a quarter. Total assets are rising massively, largely because they're stockpiling this heavy AI inventory, and they're sitting on an end cash position of $4.2 billion.
Yeah, a massive cash pile.
And their operating cash flow is $1.66 billion annually. These are the kinds of numbers you expect from a company that is absolutely dominating the market.
On the surface, yes, you would think so. But you also have to factor in their free cash flow, which is sitting at $440 million over the trailing 12 months.
Okay, and just to clarify for everyone, free cash flow is the actual cash left over after the company pays for all its operating expenses and all its capital expenditures.
Right, like building new factories or buying equipment.
Exactly. It's the money they can actually use to pay down debt, buy back stock, or save for a rainy day. Now, $440 million sounds great. But wait, if they are pulling in $22 billion a year in revenue, why is the free cash flow only $440 million? Where is the friction there?
Well, this is the exact fundamental issue that is holding the stock down right now. If we connect this to the bigger picture, all that top-line revenue doesn't actually mean anything if the costs to generate it are eating you alive.
Right.
And that brings us to the margin problem. Despite bringing in nearly $22 billion, their net profit margin is a microscopic 3.11%.
A 3.11% net margin. That is razor thin. I mean, it's almost grocery store level margins. How is a company at the bleeding edge of the AI revolution building the servers that power the most advanced technology on Earth, keeping so little of the pie?
It comes down to the brutal physics and economics of modern AI data centers. In Q2 of 2026, their gross margins plummeted to just 8.02%.
Wow. From what, like the mid-teens previously?
Yeah, they used to be much healthier. To understand why it dropped, you have to look at what they are actually building. SMCI specializes in high-performance AI infrastructure, specifically liquid-cooled servers.
Okay, liquid cooling.
Right. When you pack thousands of advanced NVIDIA GPUs into a single server rack, they generate enough heat to literally melt the components. Traditional air conditioning just doesn't work anymore.
Right, you can't just blow a fan on it. You have to pipe cold liquid directly to the chips.
Yes, and that requires incredibly expensive input costs. We are talking about custom copper cold plates, specialized manifolds, massive cooling distribution units, and proprietary coolants.
Sounds pricey.
Very. The supply chain for these components is super tight and incredibly expensive. And at the exact same time, SMCI is fighting a brutal price war to win massive data center contracts against legacy behemoths like Dell and Hewlett-Packard Enterprise.
Ah, so it's a squeeze from both ends, I see.
Exactly.
They have to lower the price of the servers to beat Dell and actually win the contract, but the physical cost of the copper, the cooling systems, and the inventory required to build them is skyrocketing.
Yep, you nailed it.
So while the money flowing through the front door is this raging river, the money going out the back door to pay for parts and maintain your market share is basically a waterfall.
That's a great visual. It takes massive amounts of capital just to stay in the game right now. That microscopic margin perfectly sets up the central debate of this company. Is this stock a hidden bargain because they are capturing market share that will eventually become highly profitable? Or, is it a value trap designed to catch overly optimistic retail traders who just don't understand the underlying costs?
Well, let's look at the valuation metrics, because this is where retail investors get really confused. Right now, SMCI trades at a PE, a price-to-earnings ratio of roughly 19.69x to 22x, depending on which forward estimates you use.
Right.
Now, historically, during the height of the AI boom, this stock traded around 35x earnings. So if I am a retail investor sitting at home, I look at a 19x PE for a tech giant leading the AI hardware space, and I think, wow, this is incredibly cheap. I need to back up the truck.
A lot of people think that.
Right. Why shouldn't I? What is Wall Street seeing that I'm missing?
Wall Street is seeing a massive legal and regulatory headache. Analysts are issuing hold and neutral ratings across the board right now. I mean, Mizuho recently lowered their price target from $33 down to $25.
Ouch.
Yeah. JP Morgan downgraded their target to $28. What they are doing is applying what we call a governance discount.
A governance discount, okay? Meaning the math on the actual business might look good, but the people running it or the rules they are allegedly breaking make it too risky to touch.
Yes, exactly that. SMCI is currently facing federal securities lawsuits regarding their accounting practices. And on top of that, they have severe export control allegations regarding sales of advanced technology to China.
That's a heavy combination.
It is. Now, we're purely analyzing the data here, so we aren't taking a stance on whether these allegations are true or false. But from an institutional investment standpoint, the truth almost doesn't matter in the short term. The uncertainty is the problem.
Because big money hates uncertainty more than anything else.
It's algorithmic, honestly. Many large institutional funds and risk parity models have strict compliance mandates. If a company is under active federal investigation for securities violations or export control breaches, these funds are literally forced by their own internal risk departments to liquidate their positions.
Wow, forced to sell.
Or at the very least, halt any new buying. They don't wait for a verdict. The risk of a massive regulatory fine, or worse, being delisted, is a psychological time bomb.
So it doesn't matter if the RSI is cooling down or if the MED is showing a beautiful bullish divergence. If a compliance officer at a multi-billion-dollar fund says you cannot hold a stock with an active federal probe, the portfolio manager just has to hit the sell button.
Exactly. And that is exactly why retail traders get trapped. They focus entirely on that 19.69x PE ratio and think it's a bargain, completely ignoring the structural reality that the big money cannot and will not step in to drive the price higher until the legal reality is completely cleared up.
It's like buying a cheap house without realizing it has a massive lien on it.
Right. The bears argue that this isn't a cheap tech stock at all. It's a highly risky asset priced exactly where it should be given the massive unresolved legal risks.
Okay, but here's where it gets really interesting. I want to push back on that because you simply cannot ignore the bull case.
Let's hear it.
Let's assume for a second that SMCI survives this legal drama. They pay a fine, they clean up their accounting, and the dark clouds just part. The upside scenario here is absolutely staggering. I was looking at their forward guidance. SMCI is targeting $40 billion in revenue for fiscal year 2026. $40 billion.
It is an astronomical figure.
Yeah.
And it is entirely based on their technological edge. They are the undisputed market leader in building out these liquid-cooled architectures. As we talked about, data centers are getting hotter and the power grids are just getting maxed out.
Yeah.
So liquid cooling isn't just a luxury add-on anymore. It is a physical necessity to run next-generation AI models.
Right. If you want to train the next massive language model, you need tens of thousands of GPUs. And if you plug them all in, they will literally catch fire without SMCI's technology. So they're essentially selling the highest-end, custom-forged pickaxes during the greatest gold rush in human history.
That is the core of the bull argument right there. The bulls look at the shrinking margins and say, yes, the margins are squeezed right now. But SMCI is deliberately sacrificing short-term profit to capture absolute market dominance.
A land grab.
Exactly. They believe that once SMCI scales past this current heavy investment phase, once the supply chains for the copper and the coolant are fully optimized, the gross margins will stabilize and expand. And if they actually hit that $40 billion revenue target and their margins improve even slightly,
Then what?
well, then a PE in the low 20s won't just look cheap. It will look like the steal of the decade in hindsight.
So what does this all mean? We have two totally divergent realities here. On one hand, a technological juggernaut poised to double its revenue to $40 billion, holding the keys to the AI kingdom.
Yep.
And on the other hand, a company bleeding cash on inventory, operating on microscopic 3% margins, and dodging federal investigations that are keeping institutional money completely sidelined. Taking both of these perspectives into account, what should the listener expect next? Let's break down the timeline. What is the short-term outlook over, say, the next few weeks?
In the short term, the technical data we discussed earlier is going to be the dominant force. The market desperately needs to digest that overbought RSI signal. The stock sprinted too hard off the $20 floor, and the buyers are just tired.
Makes sense.
Because of that, the immediate outlook is short-term weakness or, at best, sideways consolidation. You should really expect the price to chop around in a tight channel between $25 and $30.
Basically, the stock needs to move sideways to burn off that excess momentum without losing its footing.
Exactly. Wall Street is basically going to sit on its hands and wait for two things: technical cooling and legal clarity. Until one of those things happens, the stock is trapped in a holding pattern.
Okay, but what about the long game? Say we look out past the chop of the next month, and we look out to the end of the year or into 2027. What happens then?
Well, if we look out through 2027, the macroeconomic picture is actually incredibly robust. The underlying foundation of SMCI's business is the capital expenditure from the major tech companies, Microsoft, Google, Meta.
Hyperscalers.
Right. They are all signaling that they are going to spend hundreds of billions of dollars on AI infrastructure over the next few years. The demand for SMCI's product is essentially guaranteed.
The money is already allocated. It's just sitting there waiting to be spent.
Yes. If SMCI can successfully resolve its governance issues, like if they satisfy the regulators and clean up their reporting, their technological edge over legacy competitors could trigger a massive recovery.
Because the bans are lifted?
Exactly. Once the institutional compliance bans are lifted, the big money that has been sitting on the sidelines will rush back in to capture that $40 billion revenue pipeline. That is the best case scenario.
And the worst case?
If the legal probes deepen, or if Dell manages to undercut them permanently on price and steal their market share, the stock could easily break back below that $19.48 floor we talked about.
Wow. So to summarize this incredibly complex puzzle, we have a stock that has bounced beautifully off a hard floor of $20, but is hitting mathematical exhaustion near 31. We have billions of dollars in cash flow, but physical supply chain realities that have shrunk net margins down to, well, grocery store levels.
Yeah, 3%.
And we have a product that the entire AI industry relies on, wrapped in a terrifying legal and regulatory chassis that has algorithms forcing institutional investors to literally sell.
It really requires anyone looking at SMCI to choose which timeline they actually believe in. Do you believe the governance issues are a fatal flaw that will continue to drag the stock lower, creating a classic value trap? Or do you believe the $40 billion revenue pipeline and AI hardware dominance will eventually eclipse the current turbulence, making this a deeply undervalued asset?
It is the ultimate test of an investor's conviction. You really have to decide if you are buying a broken company or a great company going through a break-in period. And, well, that wraps up our fundamental and technical analysis for today. Thank you for joining us on this deep dive into SMCI's turbulent charts. Again, just a quick reminder that this was a pure analysis of the data and the mechanics of the market, not advice to buy or sell.
But before we close this out, this raises one final, highly important question, one that we haven't touched on yet, but that you, the listener, should absolutely research on your own after this.
Oh, I love these cliffhangers.
Yeah.
What is the missing piece of the puzzle here?
We've talked extensively today about market sentiment. We've talked about retail traders trying to catch a falling knife, what the moving averages say, and, why algorithmic risk models are forcing Wall Street to issue hold ratings.
Right.
But what about the people actually inside the house? Given all this volatility, the shrinking margins, and those massive looming legal risks, what would we find if we analyze the insider trading history of SMCI executives? To specifically people like CEO Charles Liang over the last 6 months.
That is a fascinating angle, because if the stock is truly a deeply undervalued bargain at a 19x PE, and the legal issues are just overblown noise, you would expect the executives to be aggressively buying the dip, right? I mean, they know the reality better than any analyst on Wall Street.
Exactly. But if those legal risks are as bad as the institutional bears claim, and the margins are permanently crushed, are the insiders quietly heading for the exits and selling their own shares?
That is the million-dollar question. It's one thing to calculate free cash flow or look at a MACD indicator. It's another thing entirely to watch what the people holding the steering wheel are doing with their own personal wealth.
Follow the insider money, and you might just figure out which reality is the true one.
I love that. A perfect lingering thought to take away. Is it an undervalued strong buy or a dangerous value trap? Don't just ask the charts, ask the people running the company. Stay curious, keep digging into the data, and we will catch you on the next deep dive.